Hello, everyone, and welcome to our assessment of MGM Resorts and the opportunity to present to you all the acquisition of fantasy experts DraftKings with respect to MGM Resorts International. Next slide, please. Our agenda for today consists of the following items shown on the screen here. As you can see, we dive into various forms of industrial, financial, and valuation analysis. This will lead us directly into our final recommendation at the very end. Next slide, please. We here at Golden Lion Asset Advisors first and foremost want to put in the forefront that we prioritize risk management, long-term vision, and above all, integrity when operating on pursuits so large such as this one involving MGM Resorts International and DraftKings. Next slide, please. Now, if you could please meet our fantastic team here. We consist of Romulo Casavilca, Jamie Ye, and myself, Victor Munoz. Consisting of extensive experience, diverse skill sets, and a proven track record of successful mergers and acquisitions over 30 years of combined experience, we are here to make possible what is otherwise thought of to be impossible. I will now pass it off to our first talented team member, Romulo, for an industry overview.
Thank you, Victor. So for the industry review, we are considering competitive rivalry. We see the market share of all the big companies that are in this industry. So we just noticed that DraftKings has 25% of the market share and MGM has 12%. If they are able to combine, we will have a combined market share of 37%. For the regulatory analysis, right now, what is most important is that 33 states have legalized sports gambling and 10 are more in process. And this is a big opportunity. Also, for the market growth, we noticed that from 2019 to 2023, the average growth was 88.3%, which is also another opportunity, big opportunity to acquire this business. The states that are in green are key for growth, which is California, Florida, and Texas. Now I will pass it off to Jamie.
Thank you, Romulo. So now I'm going to introduce our Porter's 5 forces approach. So we use this model to analyze the attractiveness of the online gambling industry and identify some of the high and low powers. And usually a high power represents disadvantages and vice versa. So I'm going to concentrate on the high power components. The first one is power of buyer. Provided 176 million customers in the online gambling industry, generating 95 billion revenue in 2023. Although some of the forces we just mentioned seem to be in the market participants' favor, the power of buyer is obviously high. Customers are sensitive to fees for deposit and withdrawal, and technically they have nearly zero switching costs. And the other high power component is the rivalry among existing competitors. Earlier, we mentioned that it is difficult for new entrants to participate. However, it's also true that the competition among existing players is fierce. So one of the most popular means of gaining more market shares in this industry is through M&A. Some of the reasons is that on the supply side, their products offerings are not particularly diverse. Nearly all competitors are offering same betting services to customers. Moreover, because the bar is high in the very beginning, the remaining competitors have been consolidated and high quality. On the demand side, because the switching cost is low, customers will shift to other providers, whichever offers a bigger welcome bonus or more versatile user platforms. Next, we'll identify some synergies between, unless I'm gonna switch over to Victor for SWOT analysis before I identify some synergies between MGM and DraftKings.
Thank you, Jamie. And as Jamie was mentioning with a lot of the Porter's 5 forces elements, a SWOT analysis of DraftKings indicates overwhelming strengths. With over 2.1 million users monthly and a unique fantasy users sports interface and plus a 20% year-to-date stock performance, DraftKings possesses strengths before even considering the user base of MGM Resorts. For opportunities, we see a unified and extensively large user base available through brick-and-mortar means and online through the large network of MGM properties around the world, and namely on the Las Vegas Strip. As for weaknesses and threats, we are headlined by the fact that gambling is not quite legal around the USA, as mentioned by Romulo. Legislation is trending positively, but the vital piece is that currently only a handful of states, 33, can legally use online platforms for gambling stemming from MGM businesses. Additionally, a massive threat is that of other online entities such as Bet365 and FanDuel merging with other Las Vegas property giants. Next slide, please.
So now I'm going to talk about some possible synergies with DraftKings. So first of all, when dissecting DraftKings business segments, 98% of the revenue comes from B2C and 2% comes from B2B. And in the B2C segment, money comes from three services: daily fantasy sports, the DFS, sportsbook, and also online casino. We believe what makes DraftKings customer base special is their DFS users. Unlike other online gambling providers, DFS is DraftKings' founding business. DFS players tend to have greater brand loyalty and achieve a higher daily active time due to the nature of the game. Also, many of these DFS players are sports fans and have been rooted into DFS since they were teenagers. According to our research, about 30 to 40% of DraftKings Sportsbook customers came from pure DFS accounts. This is a huge opportunity to expand the client base in online gambling. Currently, DraftKings spends about 70% of sales yearly in sales and marketing, 20% in product and technology, and 57% in general and administrative. This cost can be cut when MGM acquires DraftKings because they already investing in these categories with their BetMGM platform. And on the revenue side, MGM will get more market share and it's at least 37%, which means they will increase their MUPs and RMUPs as well. Now I'm gonna pass back to Victor for our target WAC.
And as for target WAC, we start off by compiling the financial numbers for the year 2022. We use a combination of market values, the short-term debt and the long-term debt, as well as the weights that were calculated for equity and debt in order to really begin calculating the WAC. And here we see that we will base our market premiums based on a range. Next slide, please. Using the values from the previous tables shown on the slide prior, we use the formula shown on the screen here to then calculate our target WAC. And based on the range that we have, we will be proceeding with a target WAC of 12.38 based on the market premium of 6%. Next slide, please.
Now we will proceed with the valuation income approach. Here are the following main assumptions that I will talk about. In the capital expenditures module, we'll do a conservative measure. We will take the average growth of the last 3 years, and this was taken from the cash flow statements from the company. In the depreciation module, we will take the last year depreciation expense and add the new expense by considering the expected expense and divide it by the average life of assets. Another important assumption of this model is our EBIT margin. In this case, our target company has negative values because of the temporary circumstances, allotted spending, marketing, and technology. However, this doesn't mean that the company is in distress. It just means that it's in the phase of heavy investment in technology and publicity. Thus, assuming that the company will generate positive EBITs after 2023, as stated in the Q2 update, we will assume the industry EBIT margin of 17.34% with a tax rate of 35% to calculate our NOPAT. Finally, for the terminal growth, we will assume 5%, which is close to the rate of inflation at June 2023, and apply the WAC of 12.38% to get a discounted terminal value. After plugging everything to our DCF model, we calculate a share price of 36.73, which is very close to other consensus. As we can see, the company should not pay more than 42 per stock. But by conducting our sensitivity analysis, the maximum price should be 42 per stock. We believe that at the price of 34.47 for the target is the best deal, and we will get to that number in later slides.
So now I'm going to talk about market approach. As our team employ market approach to calculate DraftKings valuation, we identify 6 public traded companies that are also either in the casino or online gaming industry in the United States. They were Caesar Entertainment, Churchill Downs, PAM Entertainment, Las Vegas Sands, Take-Two Interactive, and Electronic Arts. All 6 of them are similar to DraftKings either in their sizes, for example, Caesars, or their concentration in betting such as Churchill Downs, or their presence primarily online like Take-Two. However, the caveat of selecting these comparable companies is they don't solely focus on online betting, which only represent one of their major businesses. Since DraftKings has yet scored profits, we were unable to use multiples related to earnings such as EBIT and EBITDA. Therefore, we decided to use enterprise value per last 12-month revenue and price per book value to find the appropriate equity value per share of DraftKings. And before filling in DraftKings financial metric, we compile the data into a table here with a range of multiples. Next slide, please. And in the last step, we use DraftKings' respective last 12-month revenue and book value to calculate its implied enterprise value and equity value. After getting 2 sets of implied equity value per share with the 2 multiples, we each apply a weighting which is 80% for the enterprise value per last 12-month revenue and 20% for the price per book value multiple. The reason we place a higher weighting on the first one was we believe for a no earning company, a multiple out from the sales number make more sense. As a result, we arrive at a range of weighted equity value per share from $10.86 to $37.76, and that's shown at the bottom of the table. And now I'm going to pass over back to Romulo for combination analysis.
Thanks, Jamie. So for the combination analysis, here are the following assumptions. The merger company, MGM, will purchase the target company with 40% debt, 10% of cash, and the rest with equity financing. As shown in this analysis, to be conservative, we will assume that MGM is purchasing the target company with 30% premium. This means that the EPS will be diluted for the next 2 years with no synergies. However, if we want to break even by the next 2 years in the EPS at 30% premium, the merged company will need to cut its operating expenses by 40% and 11% in the next years, which is reasonable to accomplish. In our possible synergies analysis, we stated that the cost synergies is estimated to be around 30 to 50%. So here's our valuation summary. Our target price is $34.47 by applying the Delaware block method. It is common to assign more weight to the discounted cash flow because it's a fundamental and widely accepted approach for valuing a business. Now I will pass it over to Victor.
Thank you, Romulo. And just to tie it all up, we value due diligence and underwriting with the utmost importance here at Golden Advisors here. And so the 2 questions of due diligence that we'll be highlighting as part of this segment here is 1, we would like to see DraftKings bylaws, and we would like to see how they currently operate internally and what bylaws they have in place before being acquired. Secondly, and most importantly, we would provide DraftKings with a antitrust FTC checklist such that they can fill it out and provide answers to what we are seeking, such that we can get through any antitrust legislation checks without any bells or whistles going off at the U.S. government. Next slide, please.
And before bringing you our recommendation, I'm going to use a little bit time to introduce our financing approach. Knowing DraftKings has yet to turn profitable and the game of online betting will lean towards a winner-take-all situation, or at least facing more consolidations in the near future, our team suggests the board of MGM to apply a strong bear hug tactic to make a public aware of their M&A, their merger acquisition attempts. And by making this news public, we want to reduce the resistance from the board, particularly from the founders of DraftKings. And so we saw our recommended initial offer price will be $29.23 per share. And that's representing a 10% premium of current stock price. And we are not recommending a price higher than $34.47, which is more than 20% of premium and already matched with our calculated weighted price using the Delaware block method. Now I'm gonna bring it back to my team to introduce our recommendation.
In our final recommendation, as you can see in the handouts that you have been presented as well, we will highlight a few of the items here that support our strong positioning for a strong resounding yes that MGM should then now acquire the target company DraftKings. First of all, we'll look at just how massive of an opportunity MGM has right now to jump the market and mainly jump the other Las Vegas giants such as Caesars, Churchill Downs, and other Las Vegas giants that are part of the Strip and have brick and mortar facilities. And it is just an opportunity to take advantage of the potential growth that this industry currently has, especially in the online landscape, where now after anticipating 88.3% growth on average yearly, we have absolutely no idea how unprecedentedly huge this growth will be once key states such as California, Texas, and Florida legalize sports betting. So for any questions regarding any of the materials that we have covered today and our supporting recommendation, feel free to contact any of us at any time, and we will be more than happy to support our decision here presented today. Thank you.